ratio analysis. So there's a question which I'd shared some time back on ratio analysis. I've still shared the question. The question on the group is written as assignment. The question on the group is written as assignment. You can open that question. You can open that question. Then there's another one which I've also been able to share. There's another one which I've also been able to share. We'll also be able to look at that one. So the question reads, there's a question there which I've written. I sent it some time back and I told you to do as an assignment. So no one was able to respond, even send whether they have done or not. So we can start by having to look at that one. The following are the financial statements of Utajiri Limited for the year ended 30th of September 2022 and 30th of September 2023. So you have a statement of profit and loss. Then in this case, we have a statement of financial position as at 30th of September. So there are two financial statements there for the 2 years. Then you've actually been called upon to prepare the current ratio, the quick ratio, average trade receivables collection period, the gross profit margin, the interest cover ratio, return on capital employed. Then we have earnings per share. We have earnings per share. So the most important thing here is for you to be able to know the formula. Is for you to be able to know the formula. So for example, if you start with the first one there, we are being called upon in this case to calculate what? The current ratio. The current ratio. We are being called upon to calculate the current ratio. The current ratio. So what is the formula for current ratio? What is the formula for current ratio? What is the formula for current ratio? Current ratio. What is the formula for current ratio? What is the formula for current ratio? If you want to do the current ratio, what is the formula? The current ratio. So I can see Irene says current assets minus current liabilities. I can see Lavin says current assets over current liabilities. So current assets over current liabilities. Others are saying current assets minus. Is it, Joseph, are you saying minus current liabilities, or what do you mean? So it's supposed to be in this case what? Current assets over the current liabilities. Current assets over the current liabilities. So what you need to do in this case, you need to go to those financial statements you've actually been provided with. And in this case, try to identify what is the total value for current assets. What is the total value for current assets? And what is the total value for current what? Liabilities. Then, of course, there are 2 years. So there are 2 years there. So we can have in this case 2022. You can have in this case 2022. 2022. And we have in this case 2023. So then you've been told compute the following ratios for the years ended 30th and of course 30th of 2023. So in this case, you have 2022 and of course you have 2023. 2022 and of course 2023. So what is the value of current assets? What is the value of current assets? The value of current assets, the value of current assets. The value of current assets is what? We'll take what over what? For 2022, we'll take what over what? For 2022, we'll take what over what? Simuli. We'll take what over what for 2022? 2022 will take what over what? 2022 will take which figure divided by which figure? Which figure divided by which figure? Omondi, for 2022, we'll take which figure divided by which figure? I can see 3110 over 1915. Over 1915. Over 1915. Another person can be able to try. We'll take 1710 over 745. So you need to be very keen when you're having to pick out the figures. For example, Nekesa, this figure you have actually given us of 31,110 is the total value of assets. So you need to specifically pick the total value of what? Of, in this case, what? The current assets. Which in this case, if you look very keenly, you'll be able to see 1710. Then the total value for current liabilities is exactly what? 745. So it is 1710. So 1710 over 745. Then still the same case, we take the figures for 2023. It will be 2195 over 610 over 610. So when you divide this on, what do you get? 1710 over 745. Irene, 1710 over 745. JB, 1710 over 745. 1710 over 745. And 2195 over 610. So 1710 over 745, you get which figure? It is 2 point something, 2.5, 2.4, 2.4 something, 2.293. We can round off to one decimal place. We can say 2.3. So we normally say 2.3 is to 1. 2.3 is to 1. So like that. Then that other one, it will be 3 point something. 3 point, it will be 3.5. 3.5. You need to round off to the nearest one decimal place. To the nearest one decimal place. So it will be 3.6. 3.6 to 1. So it means in this case, the current assets can be able to cover the current liabilities 2.3 times. The current assets can be able to cover the current liabilities 3.6 times. 3.6 times. So the next one in this case, you are called upon to compute. It is the quick ratio. It is the quick ratio. So what is the formula for quick ratio? What is the formula for quick ratio? What is the formula for quick ratio? The formula for quick ratio. What is the formula for quick ratio? The formula for quick ratio. Quick ratio. Sometimes we call it what? Acid test ratio. We sometimes call it acid test ratio. Sometimes we call it acid test ratio. Acid test ratio. So we'll take the current assets minus inventory. So the current assets minus inventory over the current liabilities. So we want to know in this case, how quickly can the current assets be able to cover the current liabilities? So most obviously we mean we'll have 1710 minus over 745. We'll have 2195 minus over 610. So we need to identify what is the value of inventory. What is the value of inventory in our statement of financial position? So for in this case 2022, it is 490, and for not 490 but 800. So it is 800, and in this case for 20, this one is 1200. 1200. So you can be able to do the computation. So what is now the ratio? What is now the ratio? When you divide, what do you get? When you divide, what do you get? So 1710 minus 800 divided by 745. You'll get 1 point something. 1.1 or 1.2. 1.1 or 1.2. 1.1 or 1.2 there. So you can do the computation. For 2022, it will be 1.2. So it will be 1.2 is to 1. 1.2 is to 1. What about this one? So that one will be also 1 point something. Around the same, 1 point something. 2195 minus 1200, I think around 1.5, around 1.5. Around 1.5. So 1.6 is to 1. 1.6 is to 1. 1.6 is to 1. So if we only utilize the assets which you can be able to convert into cash very quickly, so how can we be able to cover the current liabilities? If we have the quick assets. So if you minus there, you remain with what? Trade receivables and cash in hand. Those are quick assets. Trade receivables, you can easily convert it into cash when you aggressively collect from debtors. So that is money that is easily available. If you compare with the money that is easily available, the quick current assets, can they be able to cover, in this case, the current liabilities? So the most ideal ratio is normally, it should be around 1 to 1. So these ones are actually having to operate what within Good limits. They're having to operate within what? Good limits. So it should averagely be around 1 to 1. So that is the most ideal. That is the most ideal. So we can go to the third one. The third one, in this case, you're having to be called upon to compute average trade receivables collection period. So average trade receivables collection period. Average trade receivables collection period. So what is the formula for average trade receivables collection period? Average trade receivables collection period. What is the formula for average trade receivables collection period? Yes, it's a ratio. You are supposed to include. So this is the correct answer. What you are putting here is the correct answer. You're supposed to include, as we've been able to put in there on the board. You're supposed to include it there. You're supposed to say it is to 1. It is to 1. So that is how you present that ratio. So you're supposed to present it like that. So I can see you're saying average receivables over annual credit sales. Average receivables over annual credit sales. So they are saying average trade receivables collection period. A period, I think a period will have, is it in this case what? Days. It will have days. So confirm that formula. Confirm that formula. So confirm that formula again. It might be correct, but also it might end up not having to be what? It might not actually end up having to be what? Complete. It might not actually end up having to be complete. Lavin, is that formula of yours correct? Irene, ask yourself, is that formula of yours correct? Is that formula of yours correct? So you need to multiply with what? 365 days. So not number of years, but the number of days in a year. So what's our Lavin? Number of days in a year. So we'll be able to check the average debtors, average trade receivables, average trade receivables, average trade receivables. So it is average trade receivables, average trade receivables, average trade receivables over, you divide by the credit sales that you made in the year, credit sales that you made in the year, multiply by 365 days. Remember, you've been told, if you look at, in this case, the question on the introductory parts, you've been told on the required, compute the following ratios for the years ended 30th of September 2022 and 30th of September 2023. Assume a 365-day year. So they knew you'll be able to use those days there. So now in this case, we need to identify our average trade receivables and of course what our credit sales. So in this case, you've been told 80% of the sales is exactly what? Is actually on credit. Is actually on credit. You can be able to see that in the statement of income. You've been told 80% of the sales is actually what? On credit. The net sales, 80% of the net sales is actually what? On credit. Then the trade receivables, you can actually be able to get them in the statement of what? Financial position. So we have 490 and of course now what? 600. So it will likely be 490 over, in this case, the credit sales, you'll be able to take 80% multiply by 4,400. So remember, these figures you're having to use here, they're in shillings of millions. So we can be able to indicate up there. The figures you're using here are in shillings of millions. You can be able to indicate there. So you'll take 80% of 4,400, then we multiply by 365. Then for this other one, the trade receivables is actually 600. We divide by the credit sales, which will be 80%, multiply by 5,100, you multiply by 365. So what do you get? 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 The first one, what do you get? 490 over 80% multiplied by 4,400 multiplied by 365 days. Because those are days, 365 days. You can be able to put there days. 365 days. 365 days. So what are you getting for the first one? You're getting 50.8 days. So averagely, in this case, you can be able to say how many days? 51 days. You can say 51 days. You can say 51 days. You can say 51 days. Then this one is how many days? 600 over 80% multiplied by 5100 multiplied by 365. You get 54 days. You get 54 days. You get 54 days. So what this one means, in the year 2023, they were taking longer to collect from debtors by 3 days. So this particular is basically the average period you take to get your money from your debtors. Averagely, if you do the computation averagely throughout the year, you normally take around 51 days in 2022. And in 2023, you took in this case 54 days. So here, they were taking long to collect from what? From their debtors, or to turn their debtors into what? Into cash. To turn around their debtors into cash, they were taking long in the year 2023. So the average trade receivables collection period, Then the next one, you've actually been called upon to compute. The next one you've actually been called upon to compute. It is the gross profit margin. So that one is very simple. Gross profit margin. So this one, you take the gross profit, you take the GP over sales, you multiply by 100%. The gross profit over sales, you multiply by 100%. Let's assume you are told net profit margin, you'll take net profit over the sales, multiply by 100%. So if you look at 2022, the gross profit is actually 2200 over, in this case, 2200 over, in this case, the sales, which is the 4400, you multiply by 100%. Then for this other one, the GP is actually 2250 over the sales, which is 5100. Then you multiply by 100%. 100%. So that is 50. This one is 50. This one is 50. I think it is 50%. Then the other one is it 40 something? Around 40 something. So what is the percentage for the other one? The gross profit margin for the other one. This one is 50 and the other one is 44. So it would be 44. So this one is 44%. So the gross profit margin in 2022 is actually a bit higher compared to what 2023. So we can go to the next one. The next one in this case is the interest cover ratio. The interest cover ratio. The interest cover ratio. So the interest cover ratio. What is the formula for interest cover ratio? So always be able to know the formula. The interest cover ratio. The interest cover ratio. The interest cover ratio. What is the formula for interest cover ratio? EBIT over interest expense. Profit before interest and tax over the interest expense. So you're having to say EBIT over the interest expense, EBIT over the interest expense, EBIT over the interest expense. So of course, the interest expense you've actually been given. So it is in the income statement. We have in this case 45 and of course what 60. We have 45 and of course what 60. Then the earnings before interest and tax. The earnings before interest and tax, also we have them there. The net profit before interest and tax is 1560. And of course, in this case, what? 1340. 1340. 1340. 1340. So in this case, we have what? EBIT, the earnings before interest and tax, EBIT over the interest expense, over the interest expense. So of course, now in this case, we just want to know how many times can the earnings we have in the company be able to cover for what? For the interest. Because in this case, those are what? Earnings before you charge interest and tax. So we want to know how many times can these earnings we have in the company be able to cover these what? Interests. So it can be 3 times, it can be 4 times. So the more times it is, the far much the company is better. The more times it is, the far much the company is better. It means in this case, they have adequate earnings to even cover for what? For their finance expenses. So if they have, for example, got a loan, they have got debentures, which are supposed to be paid for interest, they'll be very comfortable to pay these interest. So these are kind of a ratio that in this case can be analyzed by, for example, a lender. A lender, you can be able to look at, for example, the previous years, how comfortable has this company been able to settle its interest expense. So when he looks at the interest cover ratio, he'll be able to know they have comfortably been able to cover their interest expenses with the earnings they're having to receive. So he can, in this case, comfortably be able to lend the company because the number of times the earnings they're having to have to be able to cover for the interest, the company is very strong. So it is more times. It is actually more times. And therefore, they are very comfortable to do what? Maybe to pay interest. So therefore, you can comfortably be able to make what? The lending of what? Of the money as a lender. The lending of the money as a lender. So therefore, in this case, we can be able to do the computation there and see how many times it is able to cover. See how many times it is able to cover. So you have in this case 1560. So 1560 over 45. Then in this case we have 1340 over 60. So you can do the computation. You can do the computation so that we know how many times in 2022. You can do the computation so that we know how many times in 2022. So we have 22 times, that is 2022. This is 22. So you have in this case 22 times. Then what about this one? That one is 20. Still 22. Is it still 22? Is it still 22? Yes, 22 point something. I think 22 point something. 22 point something. It is 22.2. So for 2022, it is 35. This one is 35. Huh? This one is 35. Then this one is 22. So it means in this case, in the year 2022, they were doing so well in terms of that ratio. So in the year 2022, they were doing so well in terms of that ratio. They were able to cover their interest so many times compared to 2023, compared to 2023. So they are very comfortable in the year 2022 compared to the year 2023. Then in this case, the next ratio have actually been called upon to compute. It is in this case what we refer to as the return on capital employed. Return on capital employed. Return on capital employed. What is the formula? So always in this case be able to state the formula. So the formula is everything. So sometimes we call it what? ROCE. ROCE. We call it ROCE. 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 What do you get in this case, ROCE? 2022, it is 34. 34.6. So we can be able to round off to the nearest. We can just say 35 times, no problem. can just be able to round off to the nearest is 35 times, 35 times, 35 times, and the other one 22 times. So what is the formula? So I can see EBIT. We have EBIT over capital employed. EBIT over capital employed. Someone is saying earnings after tax over the net assets. Is it earnings after tax or earnings before interest and tax? Is it earnings after tax or earnings before interest and tax? Earnings after tax or earnings before interest and tax? Is it earnings after tax or earnings before interest and tax? It is EBIT. It should be EBIT. Someone says it should be EBIT. Someone says it should be EBIT. Are you sure it is EBIT? So you'll be able to take the profit after tax. It's supposed to be profit after tax over, in this case, what? The capital employed. And of course, the capital employed can be the net assets, or you can actually end up having to take total assets minus total liabilities. So it is PATA. You need to take PATA. It will be part over the capital employed, over the capital employed, over the capital employed. So this one is same as what we call what? Net assets. Net assets. So you can be able to take total assets, you just minus what? Total liabilities. You take total assets, you minus what? Total liabilities. So if we look at our income statement, you need to look at the figure that is actually profit after tax. The figure that in this case is profit after tax. So you can be able to say earnings after tax or profit after tax. Then in this case, you divide by the capital employed. So the profit after tax we have there, the profit after tax we have there. So of course you have in this case net profit after tax. Net profit after tax is 11.15. So this one is 11.15. 11.15. So we divide by the capital employed. So the capital employed in this case is ideally what? The equity, the net assets. The net assets. You can do this, you can be able to do 31. You can do 31,110 minus minus in this case it's 450 plus 450 plus 745. Alternatively, you can be able to take that figure of equity there, which is 1915. Because if you do this one, you should be able to get the same figure. You should be able to get the same figure. 31,110 minus 450 minus, these are basically the current liabilities. These are the non-current liabilities. These are the current liabilities, the total liabilities. When you minus, you should be able to get this. So here it will actually be 1915. 1915. Then in this case, you multiply by 100%. You can be able to multiply by 100%. So you go to, in this case, the year 2023. So the part in this case is 1040. It is 1040. You divide by the capital employed. It will actually be in this case 2787. 2785. Multiply by 100%. Alternatively, you can be able to say 31,110 minus, you minus in this case 600 plus 610. So you should be able to get, is it 2785? 2785. So 600, so 39. This one is 3995. Sorry, 3995. 3995. So this is the total figure. So if you do the minus, you should be able to get this one. Then you can be able to multiply with 100%. So the 2022, what do you get? 2022, what do you get? 1115 over 1915 multiplied by 100%. You get 58%. So the return on capital employed is actually 58% for this one. What about this one? What about 2023? What about 2023? What about 2023? It is 37%. So you'll be able to get 37%. So that is the return on capital employed. So what is the return you're having to get with the capital you injected in? Just from the term itself, the return on your capital you've employed, on the capital you've employed. For this year, the return was so high, so they adequately utilized their capital to get a higher return. In this year, it seems they didn't adequately utilize their capital. So their level of utilization of capital in the year 2023 was not that effective compared to, in this case, 2022. So they effectively utilized their capital here, and therefore they got a high return on what they actually put in as what? As capital. So we can now, in this case, go to the next one, which is what? Earnings per share. So earnings per share. So we can go to the next one, which is earnings per share. Earnings per share. So we have, in this case, earnings per share. So earnings per share formula. So always start with, in this case, with what? With the formula. Always start with the formula, the earnings per share. So these are basically the earnings you are having for each and every share. So it will be what? The formula. So the formula. First of all, you need to state the formula. The earnings you're having to get for each and every share. So it is earnings after tax over the number of ordinary shares. So earnings after tax over the number of ordinary shares. So the earnings you're having after tax over the number of what? Ordinary shares, over the number of ordinary shares. So you need to, in this case, identify what are, in this case, what your ordinary shares. How many number of ordinary shares do you have there? How many number of ordinary shares do you have there? How many number of ordinary shares do you have there? So you can look at, in this case, the statement of financial position. Look at, in this case, the ordinary share capital. Look at the ordinary share capital. Look at the ordinary share capital so that you can be able to know how we'll be able to get the number of shares. You've actually been told we have ordinary share capital of shillings 10 per. Shillings 10 per. For each and every share is actually what? 10. So it means we'll have to divide 1 million over 10. 1 million over 10. So our nose is equal to, in this case, this one divided by this. So it will be able to come to 100. So remember, in this case, we are talking about what? Millions. So it will be 100 million. It will be 100 million. We are talking about millions. We are talking about what? Millions. So the number of ordinary shares in this case is what? 100 million. Then our earnings after tax, the profit after tax in this case here, we have 1115. So we'll be able to divide by 100. We'll be able to divide by 100. Then for this other one we have, so they're just the same. The number of ordinary shares are just the same for the 2 years. So we'll take, in this case, our earnings after tax, which is actually 1040. Is actually 1040. We divide by 100. So for this year, it will actually be 11.15, and here it will be 10.40, like that. 10.40, like that. So it means, in this case, the earnings per share for the year 2022 is higher than the earnings per share for the year 2023. So here, the amounts attributable to the ordinary shareholders were a bit higher compared to those ones in the year 2023. Year 2023. Year 2023. Year 2023. So that is basically what is happening there. That is basically what is happening there. Sometimes they can actually call upon you to comment on the ratios. So always, in this case, do the comparison and see what is happening. So for example, what we've been saying, that in this case, maybe here they were able to cover for the interest, so they are performing better compared to what? To the year 2023. Here the earnings were very strong in this case in terms of what? To the ordinary shareholders compared to the year 2023. The return on capital employed here, it means they adequately utilized their capital in the year 2022 compared to 2023. And therefore, the return on the capital they employed was actually higher compared to, in this case, what? 2023. Sometimes the examiner can call upon you maybe to comment on the ratios. On the ratios. Remember, in this case, you're having to do what? Analysis. Analysis of what? Financial statements. So comparing 2022 performance with 2023 by using what? ratios, by using ratios. So I want us to look at that other one, which I've shared there also. Just on the group, I've also shared another one. It is known as green and gold. Green and gold. It is known as green and gold. It is known as green and gold. Green and gold. It is known as green and gold. Green and gold. So green traders and gold traders are two businesses dealing with the sale of household furniture. The following financial statements were extracted from their books for the year ended 31st of December 2021. So you are given the income statement. So it has been combined. So just be very keen. They have combined there. We have the first one. The first part is the income statement, which ends with the figure of net profit of 120 and of course 150. Then after that, there's a statement of financial position, which has property, plant and equipment, current assets. It has equity and liabilities. It has non-current liabilities. Then it has current liabilities. Then it has total equity. You've been told you assume what? A 365-day year. Then required, you are called upon in this case to compute the gross profit margin. You are called upon to compute the gross profit margins. Of course, this one was very easy. This gross profit margin and net profit margin is very easy. So we have in this case two companies. We have in this case green traders and of course gold traders. So green traders and we have gold traders and we have gold traders. We have green traders and of course gold traders. So in this case, we have shillings, our shillings in million. Is it in millions or in thousands? It is in thousands. We'll be computing the ratios in shillings of thousands. We'll be computing the ratios in shillings of thousands. We'll be computing the ratios in shillings of thousands. So the first one is GP, gross profit margin, which you've already been able to say is exactly GP over sales. Exactly gross profit over sales. So the GP and the sales, you can be able to identify them from the income statement. The sales, which all of them are actually on credit. Then we have the gross profit. The gross profit will also been given. So for this first year, this first company, it is 600 over 3 million multiplied by 100%. For the second company, it is 600 over 1800 multiplied by 100%. 100%. So this is a fifth. This one is 20%. This one is a third. So this one is 33.3. You can confirm the figures. Confirm the figures. Yes, 20 and 33. Then you have this case number 2, the net profit margin. So this one is equals to net profit over the sales. Net profit over the sales. So net profit for the year. So we have in this case 120. 120. We have in this case 120 over multiplied by 100%. Then this other one is 150 over 1800 multiplied by 100%. 100%. What do you get for green traders? Green traders, what is the net profit margin? It's 4. You can see you're saying 4%. This one is 4%. What about this one? The other one is Lavin? The other one, 8.33. 8.33. This one is 8.33%. Exactly 8.33%. Then, so number 3, you've actually been called upon to calculate the return on capital employed. The return on capital employed. Capital employed. The return on capital employed, we've been able to say you should be able to take the part over the capital employed, the part over the capital employed, the part profit after tax over the capital employed, the capital employed. So we can be able to identify what is the capital employed. So we can be able to take the equity part there, which is actually 600, and of course what? 3 million. 600,000 and of course 3 million. So in this case, for this year, this particular green traders, so the part you can actually be able to get it in the income statement, the profit after tax, so after tax expenses. So this one is actually 120 over the capital employed. So you can take the equity part there, or you can be able to take the total assets minus the total liabilities. So we'll be able to have in this case over 600 times 100%. So this is the equity part, or you can say total assets minus total liabilities. Then in this case, we have for this other one, the part is 150. You divide by, we have in this case 3 million. So 3 million over 3,000 multiplied by 100%. Multiplied by 100%. Therefore, you should be able to get the figures there. So the first one, what is the ROCE? What is the ROCE for the first one? What is the ROCE for the first one? 120 over 600. I think that is 20%. Is it 20%? Yes, 20%. 20%. It is 20%. It is 20%. Then the other one is 5%, exactly 5%. So the return on capital employed for gold traders is very low. So they are not effectively utilizing their capital to generate what? Profits compared to green traders. Then the next one is return on assets. What is the return on assets? What is the return on assets? What is the formula? Get the formula. The return on assets. What is the formula for return on assets? The return on assets, get the formula. Get the formula, Mudoni, get the formula for return on assets. What is the formula for return on assets? Remember the other one is return on capital employed. But now in this case, we are looking at what? Return on assets. So it is earnings after tax over the total assets. So it is part over the total assets. So it will be part or earnings after tax, or you can say profit after tax, then over the total assets. So of course, in this case, the part here is 120. The figure for total assets, you look at the statement of financial position, it is 966. Yes, 966. So 966. Then we multiply by 100%. Then this other one is 150 over the total assets is 4,200. I think 4,200 multiplied by 100%. Multiplied by 100%. Multiplied by 100%. So you get what? The first one you get, Irene, the first one is 12.42. So we can round it off to the nearest. We can just be able to say 12%. Can say 12%. Then the other one is 4%. The other one is actually 4%. So the return on capital, the return on assets also. So this basically measures how adequately you are using your assets to generate your earnings. How effectively are you using your assets to generate your earnings? It could be machineries. So if the percentage is very high, then you are very efficient in using your assets to generate your earnings. So it means this company is effectively utilizing their assets to generate earnings compared to what? Gold traders. These ones are not efficient as these ones. So because the return they are getting in what they have injected in as assets is very low. It's actually very low. So it means there is no level of what? Adequate efficiency in terms of utilization of assets. in these gold traders compared to what? Green traders compared to green traders. Then the next one, you've actually been called upon to compute. It is in this case the asset turnover, or the current ratio. First of all, the current ratio, the current ratio, the current ratio, the current ratio, the current ratio. You can be able to so the current ratio is equals to the current assets over current what? Liabilities. Is equals to the current assets over the current liabilities. So the current ratio over current liabilities. So we need to identify, in this case, our current assets is just that is just from the statement of financial position. So the current assets is actually 408. We divide by the current liabilities. Current liabilities, it is 306. 306. Then for this other one, the current assets, it is how much? 2130. 2130. Then the current liabilities, it is in this case 480. 480. So what do you get? This one should be 1.3. 1.3. Yes, 1.3 is to 1. This one is equals to 1.3 is to 1. Then this one is, that one seems to be a bit higher, actually a bit higher. So it is 4.4. 4.4 is to 1. 4.4 is to 1 is equals to 4.4 is to 1. So it means the current assets for gold traders can effectively more times be able to cover what the current liabilities. Then the next ratio, in this case, you've been called upon to compute. It is the return on assets. The return on assets we've already done. So it is what? The asset turnover. So the asset turnover, it is the asset turnover ratio. It is the asset turnover. What is the formula? What is the formula for asset turnover ratio? The asset turnover ratio, sales over total assets. Whenever you see this term turnover, mostly there's something to do with sales. It is something to do with what? Sales, turnover. What is your, if someone asks you, what is your annual turnover? So how much are you raking in terms of revenue when you make your sales? That is your turnover. So it is something to do with what in this case? Sales. So therefore in this case, it will be what? Sales over the total assets. So you'll be able to take sales over the total assets. 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 Sometimes we call it what? Investment turnover ratio. Sometimes we can call it investment turnover ratio. So you'll take your sales. So we need to go and identify what in this case are our sales. Then we take the total assets. So what in this case are our sales. So in this case, our sales here is actually 3 million over the total assets, which in this case is 966. Then this other side, the sales is 1800 over the total assets, which in this case is what? 4200. 4200. 4,200. So how many times? How many times is the turning over in green traders? How many times is the turning over in green traders? 3.3 times. So you're getting 3.1. You can just round off 3 times. What about for gold traders? 1,800 over 1,800 over 1,800 over. So there's 1,800 over 4,200. So it is 0.4 times. 0.4 times. 0.4 times. So here they are effectively utilizing their assets to generate what? Sales. So it basically looks how effectively are you utilizing your assets to generate, in this case, what? Your sales. So here they're effectively utilizing their assets to generate what? The sales revenues. Compared to what? Gold traders. Compared to gold traders. Then in this case, you have inventory turnover. Inventory turnover ratio. What is the formula? Inventory turnover ratio. So the current ratio was number 5. This was number 5. This one is number 6. This one is now number 7. Inventory turnover ratio, the formula. Inventory turnover ratio, the formula. I can see cost of sales over the average inventory. 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 So cost of sales over the average inventory. Cost of sales over the average inventory. So we said in a situation whereby you've actually been given the opening stock and closing stock, to get the average inventory, you'll add the 2, then you end up having to minus. But if you haven't actually been given, then in this case, you just conclude that in this case, what you've been given as inventory is the average. So we look at, in this case, green traders, the cost of sales, of course, they have actually been able to compute there. It is 2,400. The cost of sales here, it is 2,400. If you look at the income statement, the cost of sales, it is actually 2,400. It is actually 2,400. It is actually 2,400. The cost of sales is actually 2,400. Then the average inventory, closing inventory, it is still there. It is 252. It is 252. So of course, you've actually been given opening and closing. So it means you'll add and divide by 2. So that's what I was having to say. You'll take, in this case, 348 plus 252 divided by 2. Then for the other one, in this case, it is 1,200. The cost of sales is 1,200. But you've been given the opening inventory. So in this case, it is 750 plus 1,170 divided by 2. So what do you get here? How many times? How many times is your inventory having to turn? The inventory turnover ratio. How many times is your inventory having to turn? It is 300. What is 300? What is 300? What is 300? Which figure are you having to say it is 300, Lavin? Which figure are you saying it is 300? I can see you're saying 8. So this one is 8. What about here? 1,200 over 750 plus 1,170 over 2. 1,170 over 2. You're getting 1. It is 1. You're getting 1. You're getting 1. You're getting 1. So in green traders, they are turning the inventory more. They are turning the inventory more. So this particular ratio will be able to indicate the frequency with which the inventory is having to be converted into what? Into sales. The inventory is having to be converted into what? Into sales. So how quickly are you having to convert your inventory into sales? into sales. It is 1.25. Maybe you can be able to put that 1.25. What about this one? You got any point? You do get any point there? You do get any point? Well, it was just flat 8. It was just flat 8. No, it was just 8. It was just 8. So here they are turning the inventory more into sales compared to what? Gold traders. So this ratio basically helps you to measure how quickly are you turning your inventory into sales. How frequently are you turning your inventory into sales? So here they are turning the inventory into sales 8 times. Here they are turning the inventory into sales 1.25 times. So here they are quickly converting the inventory. So they convert, they bring others. They convert, they bring others. They convert, they bring others. So the turning over into sales of inventory in the first company is so high compared to, in this case, in what? In gold traders, in gold traders. Then the next ratio is actually trade receivable days. Trade receivable days. Trade receivable days. So it's just the same as trade receivable collection days. Trade receivable days just the same as trade receivable collection days. So trade receivable days. Just the same as trade receivables collection days. So in this case, we said you take what? The average trade receivables over what? Credit sales. The average trade receivables over credit sales, you multiply by 365. So we said, is that the correct formula? You need to confirm. You need to confirm the average trade receivables over, in this case, what? The credit sales multiplied by 365. Multiplied by 365. So multiplied by 365. So the average trade receivables multiplied by, in this case, what? 365 over the credit sales. And of course, you've been told in the income statement, that the sales, all of them are actually what? On credit. The sales, all of them are actually what? On credit. So, and of course, you've been given the accounts receivables or trade receivables in what? In the statement of financial position. So for the green traders, it is 150. This one is 150. You divide by 3 million. You multiply by 365. So for this other one, it is 600. You divide by 1800. All the sales are on credit. 365. So how many days are you getting here? How many days are you getting in green traders? Beatrice, how many days are you getting in green traders? How many days are you getting in green traders? You're getting 19 days. So these ones, they take 19 days to be able to collect. They averagely take 19 days to be able to collect from their debtors. What about gold traders? What about gold traders? $122 days. So these ones, they take a very long period of time. So the performance in terms of collection from debtors in gold traders is very poor. So they take 4 months, averagely 4 months to collect from their debtors. They take averagely 4 months to be able to collect from what? From their debtors, to convert their debtors to collect from their debtors. Then the other one is trade payables days. So now in this case, how do you pay? Are you efficient in having to pay your suppliers? How efficient are you in having to pay what? Your suppliers. How efficient are you in having to pay your suppliers? How efficient are you in having to pay your suppliers? So in this case, we'll have the trade payable days. The trade payable days. What is the formula? What is the formula for the trade payable days? the trade payable days. What is the formula for the trade payable days? What is the formula for the trade payable days? Average trade payables over credit purchases multiplied by 365. So average trade payables over the credit purchases, we multiply by 365. We multiply by 365. So the trade payables, of course, you can actually be able to get them there. You can actually be able to get them there. Trade payables, we have in this case 186 and 330. 186 and 330. So we have in this case 186 over the purchases. So the purchases you've actually been told, all of them are on credit. So this one is 2304. So we multiply by 365. Then this other one, it is actually 330. 330 we divide by 1620. We multiply by 365. So how many days here? How many days there? So 186 over 2304 multiplied by 365. 29 days. So you have 29 days. So these ones, they take averagely 21 days to pay their suppliers. Those who have supplied them on credit, they take averagely 21 days, they have already paid, like a month. They pay within a month. Averagely, they take a month to pay them. What about gold traders? Gold traders, they take a very long period of time. So they are very poor in having to pay what? Their creditors. So 74 days. So they take a very long period of time. They take a very long period of time. So the question also in this case was having to ask us to comment on the profitability of what? Of each company. So you can always in this case compare the profitability of the two companies and be able to know how was their performance, the profitability of what? The two companies. The profitability of the two companies. The profitability of the two companies. So we can write a comment. You can write a comment about the profitability. So you can start with the first one, green traders. The first one, green traders. So how are they performing in terms of profits? We can start with the first one, green traders. Green traders. We can start with the first one, green traders. Green traders. So the company shows, you can write, the company shows a low profitability. The company shows a low profitability. The company shows a low profitability. The company shows a low profitability compared. The company shows a low profitability compared. The company shows a low profitability compared to gold traders. The company shows a low profitability compared to gold traders. The company shows a low profitability compared to gold traders. To gold traders, full stop. The company shows a low profitability compared to gold traders. To gold traders. Full stop. This is evidenced. This is evidenced. This is evidenced by the low gross profit margin. This is evidenced by the low gross profit margin. This is evidenced by the low gross profit margin and the low net profit margin. This is evidenced by the low gross profit margin, the low gross profit margin, and the low net profit margin, and the low net profit margin, and the low net profit margin. and the low net profit margin. So it means overall, in this case, in terms of gross profit margin and net profit margin, then gold traders is having to do a bit better. So you can also, in this case, have a comment on gold traders. You can have a comment on gold traders. You can have a comment on gold traders. A comment on gold traders. We can have a comment on gold traders. The company shows high levels of profitability. The company shows high levels of profitability. The company shows high levels of profitability. As evidenced, the company shows high levels of profitability as evidenced by the GP margin, 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 and the net profit margin, as evidenced by the GP margin and the net profit margin, as evidenced by the GP margin and net profit margin. The company shows high levels of profitability as evidenced by the GP margin and the net profit margin, and net profit margin. And net profit margin. Full stop. However, there are low returns. However, there are low returns. On capital employed. However, there are low returns on capital employed, and total assets. However, there are low returns on capital employed. However, there are low returns on capital employed and total assets. However, there are low returns on capital employed and total assets. However, there are low returns on capital employed and total assets, full stop. This means there is lack of efficiency. This means there is lack of efficiency in the utilization. This means there's lack of efficiency in the utilization of the capital employed. This means there's lack of efficiency in the utilization of the capital employed and the investment in assets. This means there's lack of efficiency in the capital employed and the investment in assets, 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 and the investment in assets. And the investment in assets. So that's it about ratio analysis. So you can be able to review and of course go through the other formulas we learned about in class. There are some of them we have ended not having to be able to touch on them. They are very, very common. They are very, very common because very common formulas also you will not be able to touch on. So they might end up having to be tested. You need to be very keen. You need to be very keen and know the formula. Knowing the formula is the most important thing. Then also knowing how to comment. For you at this particular level, they'll basically be so much also interested knowing how you can be able to comment on the ratios, how you can be able to use the ratios on having to do what? Analyze. So they'll maybe in this case call upon you to compute a number of ratios. Then they call upon you maybe to make what? A comment. So you must actually be able to know, why do we come up with a GP margin ratio? Why do we come up with a capital employed ratio? Why do we come up with an interest cover ratio? What is its essence? What is it having to show? If you know what it is having to show, then you can be able to make a comment in terms of the profitability, in terms of efficiency or utilization of assets, in terms of maybe in this case, the investors' decision making. So we have a number of ratios there. So you have, like in this case, earnings per share. So there are a number of ratios there that you can actually be able to compute that can enable what an investor decide whether they can be able to invest or not. So you need to go through the formulas and of course be able to at least be able to grasp them, because there is high chance they might end up having to test ratios. They might test ratios. So I think for today, I'm going to end there. You can utilize the remaining 30 minutes to be able to revise another area. So because there's something I need to attend to a bit urgently, so I'll be able to end there. So you can be able to continue revising the other areas for the remaining 30 minutes. Any burning question you can be able to ask. So we'll continue looking at published financial statements and group accounts next week. But of course, there are those other topics which are not that difficult. For example, public sector, it doesn't have a lot of issues. For example, agriculture is not that complicated. You can just have, like, when you're going through your notes, you just have like an overview about them. So they don't have, like in this case, complicated computations compared to like group or maybe published. The computations will just be moderate. If you are good in published, then I expect agriculture shouldn't actually bring a lot of troubles for you. Even in this case, professional firms like advocates, they shouldn't actually bring a lot of trouble, because for those ones, their entries are a bit direct. You debit this one, credit this one. You just know they are very direct. So they won't actually bring a lot of complications. So then in this case, there are other very common elements that you must be able to know about. We've been touching on them. Leases, we've touched on leases when you're doing other questions in the middle, in the additional information, there's there. Deferred tax. So at least to go through, in this case, deferred tax. There's a question we'll be able to do that has an element of deferred tax in our next class. But at least to go through deferred tax, because you've seen it is very common in published financial statements. Try to understand what is deferred tax, what is a temporary difference, carrying amount minus the tax base. What is the carrying amount? What is the tax base? What is a tax liability? What could end up having to lead to a tax asset? So those kind of things. So if they end up having to test deferred tax in most of the instances, they likely, in this case, bring it under what published financial statements, the way you've been able to see in the additional information. And now that is what the examiner will assume he has been able to test. Rarely they'll end up having to test it as an individual question, but you never know. You can't risk. You better just go through the topic to be very safe. Just go through the topic to be very safe. Just to be very safe, go through income taxes. Because probably next week we'll just focus on group accounts and published only for the remaining bit of the semester. But I've been able to indicate, just be prepared in each and every area. So don't say that Mwalimu told us to focus on this one so much, then exam me to panisha. But now in this case, you're having to say published financial statement, group accounts, conversion of partnership, financial statement analysis, more so ratios, and any other area. You need to be very keen about those particular areas. So I think with that, let's end there. So we'll catch up next week, our very, very final week for the semester. Our very, very final. There's also, in this case, theory. I shared some notes for theory. Make sure also you go through theory. Actually, I can advise you, maybe spend this particular weekend having to go through the theory part. Then in this case, next week, focus a lot on maybe computations. Then also towards almost the exam, also go through the theory again. You'll be far much better. There are some videos we did which are on the elements. You can review them maybe for this weekend as you go through the theory parts. The next week, we refocus again on computational parts for financial reporting. I think that will likely be okay. And by the time you get into the exam, you should actually be quite confident enough you'll be able to pass this particular paper. Remember, I told you the entries matter. You can't get into the exam with the mentality that you'll score a 0 in group. You can't get into the exam with the mentality you'll score a 0 in published. Entries are the ones that actually matter. If you can be able to put entries in the final statements, the ones that in this case don't need any form of adjustment, you'll score a similar mark, the same mark, with the one that requires computations or adjustments. So you can't get into an exam with the assumption in your head that I'll score a 0 in group. You can't score a 0. You can't get into the exam with the assumption that you'll score a 0 in published. You can't score a 0. You can't. It's all about what? Entries. The entries matter. The smart you'll be in having to pass the entries, the most important thing. The ones that need a lot of adjustments, you can leave them for a while as you basically try to do what? Rethink. So you can be able to identify very fast the entries that don't need, for example, any form of adjustment. Like closing inventory, rarely it will have an adjustment. So unless in this case, maybe you've been told they want you to compare maybe what in this case, cost versus NRV, which they rarely do. They rarely. So how can you say you'll get a 0? Yet in this case, that figure is just given the additional information. It's all about having to put it in what? In the statement of financial position. And don't be surprised. Sometimes in this case, like for example, group. So for any correct entry you make in the final statements, you score 2 marks. It doesn't matter. The one even that has adjustments, same mark with the one that doesn't have adjustments. So if you have like 4 entries in the final statements in the group that don't need any form of adjustments, easily you can score 8 marks out of 20. Easily you can score 8 marks out of 20. So just having to be smart, very strategic as far in this case you'll be able to approach the paper. That will be okay. I think that will likely be okay. That will likely be okay. Cash flow statements. So you're talking about cash flow statements. So I think we'll be able to cover it next week. So we look at a cash flow statement maybe for group, because we want also in this case to cover what? Group. To cover group. So shortcuts. So I think we've talked about a number of shortcuts. For example, I told you the shortcut to be able to do what? Group accounts. So don't expect so much magic next week. Don't expect so much magic next week. What we've covered in this case has already been magic. Don't expect so much magic next week. So don't expect so much magic next week. So we are in the very, very last minutes. So if you've been getting the advice throughout the semester, then you are in a better position. Don't expect so much magic next week. There's no so much. What the teachers have been doing and been telling you consistently through the classes from the start of the semester is what you should be able to put into your mind. So because I won't do any drama or magic next week. So I'll just come and do almost similar things I've actually been doing. So what you've basically been grasping throughout the semester is what really actually matters a lot. It is what really in this case actually matters. So I think with that we can end there. So let's catch up. Let's catch up next week.